The third quarter of 2025 finally saw some momentum after 2 quarters of uncertainty driven by the tariff wars, but a broad market recovery was absent. Instead, capital was concentrated in a few proven sectors. In this in-depth analysis of the investment banking industry for Q3 2025, we break down the key trends shaping the industry and what that means for MBA and master's applicants, job seekers, and investment bankers. We observe 6 trends. The first trend is the hyper-selective M&A deals. Globally announced deal values surged by approximately 40% year over year in Q3, pushing the quarterly total past $1 trillion, making it one of the strongest third quarters on record by value. While the total number of transactions declined to a 2-decade low, the quarter recorded a record number of deals exceeding $10 billion. This shift reflects a profound change in strategy, where the high cost of capital has forced deal makers to seek consolidations that can instantly deliver market leadership or deliver next-generation technology. The resilience of IB's leveraged finance and M&A advisory desk was proven by the successful $55 billion take-private of Electronic Arts by Saudi PIF, or the Public Investment Fund, Silver Lake, and Jared Kushner's Affinity Partners. This deal has set a new benchmark for leveraged buyout size. For the UK and European market, the trend is manifesting as an uptick in large-scale corporate separations or spin-offs, where banks advise on portfolio simplification to unlock value. For industry trends, salary trends of M7 and top 20 MBA, and in-depth curricular analysis, along with exclusive admission advice for your MBA and master's application, subscribe to F1GMAT Premium at premium.f1gmat.com/subscribe. The second trend that we observed was the trade and sales revenue hitting a multi-year high. The sales and trading division served as the industry's indispensable revenue anchor, posting its strongest performance in years. The surge was primarily driven by the fixed income, currencies, and commodities. A notable performance was Citigroup's revenue beating estimates by a notable margin, reaching over $4 billion. The volatility coming from conflicting macro signals, that is, a Federal Reserve cut mid-quarter set against persistent inflation concerns and geopolitical tensions, created optimal conditions for client hedging and positioning. The consistency of the sales and trading revenue contrasted with the low-volume, high advisory fees extracted by UBS, JP Morgan, Citi, and Goldman Sachs. The two services offered a predictable high-margin cushion to the IB fee pool for market-making and execution services. The revenue strength was driven by 2 quantitative factors. Firstly, robust client activity in interest rate derivatives and macro products as the market repriced the path of the expected rate-cutting cycle. And secondly, sustained volume in securitized products and credit trading. The third trend that we observed was Alphabet and Amazon rewarded and Meta punished. The Q3 earnings report of M7 demonstrated a new paradigm for IB's technology and debt capital market, or DCM. The market's reaction to big tech's guidance was a highly effective financial litmus test. Alphabet was rewarded for its aggressive AI infrastructure for the demonstrably strong capacity to fund it from its operating cash flow. Alphabet revised its 2025 capex up to an eye-watering $91 to $93 billion for cloud and AI, and its shares rallied. Amazon stocks surged after reporting strong AWS growth, easing investor worries about its approximately $125 billion capex commitment. For IB, this validates DCM issuance and structured financing related to data centers, next-generation chips, and energy or nuclear power assets that directly supports these hyperscalers. Meta's stock price plunged sharply after reporting Q3 results, driven by a non-recurring $15.9 billion tax charge and the prospect of even higher capex for 2026. Because Meta lacks a direct rent-generating cloud division to immediately monetize its infrastructure, investors became highly sensitive to the capex to cash flow ratio, questioning the timeline for returns on its $70 to $72 billion capex commitments for 2025. The dynamic means technology M&A and financing activity for non-hyperscalers is highly scrutinized. The market is now demanding tangible evidence of AI's revenue-enhancing capabilities or strong internal cash generation to justify multi-billion-dollar investments. So this has forced IB analysts to prioritize targets with proprietary data assets and robust, proven business models. Such scrutiny will eventually lead to mergers of upstarters in AI who cannot sustain the burn rate that the Magnificent Seven can sustain. For industry trends, salary trends of M7 and Top 20 MBA, and in-depth curricular analysis, along with exclusive admission advice for your MBA and master's application, subscribe to F1GMAT Premium at premium.f1gmat.com/subscribe. The fourth trend we observed was in healthcare M&A acceleration. The healthcare sector, that includes life sciences, medtech, and services, proved to be one of the most structurally resilient sector, with M&A deal value more than doubling in Q3 2025 compared to the prior quarter, reaching approximately $70.5 billion. The M&A acceleration is non-cyclical, driven by two deep strategic developments. Number one, the need for large pharma or biotech companies to address looming patent expirations by acquiring mid to late stage pipeline assets. And the second development is the push towards consolidation in fragmented service subsectors. IB sector specialists are witnessing a clear M&A focus on high margin, specialized capabilities such as contract development and manufacturing organizations or CDMOs, and AI-enabled diagnostics. The largest transactions often employ complex structures, such as the reported $17.5 billion Reverse Morris Trust merger of a major diagnostic unit with another firm. The quarter also saw $72.1 billion in R&D partnerships and licensing deals, underscoring that collaboration, often centered on AI-enabled drug discovery platform, remain a parallel priority to outright M&A for accessing innovation. For industry trends, salary trends of M7 and Top 20 MBA, and in-depth curricular analysis, along with exclusive admission advice for your MBA and master's application, subscribe to F1GMAT Premium at premium.f1gmat.com/subscribe. The fifth trend that we observed was US and India leading the IPO market. The global IPO market is highly selective and fragmented, driving IB's equity capital market or ECM desk to prioritize quality over volume. The Asia-Pacific region solidified its position as a global growth engine for investment banking, primarily through the continued structural momentum of India and the capital concentration in North America. Global IPO proceeds surged an impressive 89% year over year in Q3, fueled by successful listings from mature companies. This was a direct result of investors' flight to quality. Institutional capital demanded proven profitability, defensible governance, and avoidance of the cash-burning growth models of 2021. The US led the world in capital raise, achieving its strongest IPO quarter since Q4 of 2021. Crucially, India posted a standout performance, setting new records with 146 IPOs, raising $7.2 billion. China and North Asia, including Taiwan and South Korea, also drove equity gains primarily through their deep integration into the global AI supply chain, that is semiconductors, hardware, and cloud, with Chinese mainland reporting 86 IPO and Asian countries reporting 75 IPOs and Hong Kong with 66 IPOs, while US IPOs reached 180 from Q1 to Q3. For UK and European ECM, signs of revival were noted, but the market remains cautious, suggesting only the most robust, often PE-backed firms will access liquidity, making pre-IPO advisory work, particularly regarding governance and margin expansion, more valuable than ever. For investment banking, this implies a strategic shift. Asia is now turning from a region for stable M&A deal flow to a powerful and independent source of ECM revenue. Asian clients are demanding focused coverage on domestic consolidation and cross-border deals, where they could acquire technology assets in the US and Europe. The sixth trend that we observed was the surge in social bonds and green loan issuance. The sustainable finance market, while stable, underwent a structural shift driven by regulatory pressures and anti-greenwashing efforts. Total sustainable debt issuance remained flat at roughly $1.66 trillion year to date. But its composition changed. There was a reported 48% fall in sustainability-linked loan or SLL borrowing, which was largely offset by an increase in social bonds and green loan issuance. This is a direct consequence of market discipline. SLL targets were deemed too soft, prompting issuers to shift towards the proceeds-based transparency of green and social bonds. Geographically, the market is diverging. North America accounted for 44% of 2025 volumes, offsetting a reduction in traditional European issuance, often driven by large-scale social bond deals. IB's debt capital teams are now focused on navigating the complexity of new frameworks like the EU Green Bond Standard and dealing with the US regulatory pendulum swings like the changes under the One Big Beautiful Bill Act, which affected clean energy tax credits. The new developments has created a specialized regulatory and legal advisory demand in every transaction. So, to summarize, for investment banks, Q3 2025 translated into divergent fortunes. Advisory revenues rebounded sharply due to a few mega deals, while sales and trading remained the predictable high-margin anchor. The underlying economic engine driving this concentration was the AI capital cycle, with the M7 earnings report serving as the market's definitive ledger for validating or punishing aggressive infrastructure spending. The core takeaway for industry professionals is that the market now demands a strategic confluence of scale, operational clarity, and demonstrable capacity to capitalize on AI. The US still leads in deal value, but India, China, and Asian markets are catching up from highly robust demand in domestic markets. For in-depth industry trends, curricular analysis and salary trends of M7 and Top 20 MBA, and exclusive admission advice for Masters and MBA programs, subscribe to F1GMAT Premium at premium.f1gmat.com/subscribe.